What if I told you that the best time to buy a home in Utah might be right now? If you've been sitting on the sidelines and watching the real estate market and thinking to yourself, I'll buy when the interest rates come down, then this video is made for you. Because here's what nobody's telling you. By the time the rates drop low enough for you to feel good about them, you're gonna be competing with thousands of other buyers who had the exact same plan. And when that happens, prices go up, bidding wars come back, and all the leverage that you might have right now will disappear overnight. In this video, I'm going to talk to you about where the Utah market stands right now, what experts are projecting for the future, and most importantly, how you can save real money today using tools that most buyers don't even know exist. So stick around because this literally could be worth tens of thousands of dollars to you. So let's start with the numbers, because the facts matter when you're making the biggest financial decision of your life. Right now, as of spring 2026, the median sales price for homes in Salt Lake County sits at right about $550,000. And that's according to the Salt Lake Board of Realtors 2026 housing forecast. And if you're talking about just single family homes specifically in Salt Lake County, you're talking about a median price closer to $616,000. Now, here's the important context. Prices are not crashing. I can't tell you how many people I've talked to that have been watching, I don't know, too much TikTok or something, but they're being told that the housing prices are crashing. People have been saying that for years. And the fact is, they're not crashing right now. They are stabilizing. The frenzied 40% appreciation that we saw back in 2021, 2022, which was the strongest price surge in Utah real estate history, has cooled considerably. That type of appreciation was not normal, and it wasn't healthy, and it wasn't sustainable. But what replaced that frenzy was not a buyer windfall. It's more of a balanced market with steady and modest appreciation. From 2022 to 2025, Salt Lake County home prices only grew by about 3.8% over that time. And that's a far cry from the pandemic boom that we saw. But it still means that prices are trending upwards, not downwards. It may have seemed like prices came down because sellers had their prices so elevated due to what happened to the market during the pandemic. So when people came to that realization, we saw steady price decreases because the market slowed down and people couldn't get the outlandish prices that they could have gotten before. And of course, that was all due to the increase in interest rates that we saw. But how competitive is the market right now? Let's take a look at the inventory. In February 2026, Salt Lake County had just 2.9 months of available inventory, which still technically qualifies as a seller's market. Usually anything under 5 months worth of inventory is considered to be seller favored. Right now, homes in Salt Lake City are averaging about 62 days on the market, and that's up from about 58 days a year ago. So yes, homes are taking a little bit longer to sell, and that is good news for buyers. It means you have a little bit more breathing room to make thoughtful decisions, negotiate terms, and ask for concessions, something that was virtually impossible in 2021-2022. Statewide in Utah, there's just over 16,000 homes available on the market right now, and that's up about 7.7% from a year ago. That means more options for buyers, more time to negotiate, more ability to negotiate. The time to buy is right now, but that window won't be open forever. There's something that's keeping the market from flooding with inventory, and it's crucial to understand. Over 61% of Utah mortgage holders have a rate that's below 4%. These are homeowners who locked in the rate during 2020, 2021. And these people are not going to trade in their 3% mortgage for a 6 or 6.5% mortgage unless they absolutely have to. This is called the lock-in effect, and it's a major reason why, even though demand has cooled off, we haven't seen a substantial decrease in prices. There simply aren't enough home sellers, and as long as the interest rates stay elevated, that's not going to change. All right, so let's talk about the major elephant in the room, and that is going to be the interest rates. As of April 2026, the average 30-year mortgage was approximately 6.46%, according to Freddie Mac, and that's down from the peak of 7.79% that we saw in October of 2023. But that's still well above what buyers experienced during those pandemic years of 2021 and 2022, where rates briefly dipped in the 2 to 3% range. Data shows that in Salt Lake City specifically, buyers are seeing rates fluctuate between 6.4 and 6.9, depending on their credit score, loan type, and lender, and that's before any buy down strategies are applied. Now, a lot of people see 6.5% and they think, I'm gonna wait. That instinct just makes sense emotionally, but let me show you why that strategy could seriously backfire. Let's break down what the major institutions are projecting for mortgage rates for 2026 and 2027. Fannie Mae projects that the 30-year mortgage could settle in around 5.9% by the end of quarter 2 of 2026. Wells Fargo expects the rates to be around 6.14% for the rest of 2026 and about 6.19% for 2027. The Mortgage Bankers Association has their quarter 2 forecast at around 6.3%. Bankrate analysts suggest mortgage rates could bounce around 6% through the end of 2026 and possibly going down to around 5.5% if we start to see a recession type scenario. JP Morgan, on the more hawkish end, is forecasting 0 Fed rate cuts for 2026, suggesting that rates could stay elevated or even tick a little bit higher. So what does that all mean in plain English? The consensus is that rates may drift modestly lower, but not dramatically. We're not going back to 3%. We're most likely not even going back to 4%. The era of ultra low pandemic rates was driven by emergency economic conditions that just don't exist today. And there's one critical distinction that I need to make. The cuts by the Federal Reserve do not equal mortgage rate drops. This is one of the most misunderstood points in real estate finance right now. People think the Federal Reserve cut interest rates, the mortgage rates are going to go down. The Fed cut the rate 0.25%, that means interest rates will go down 0.25%. But that's just not how it works. The Fed controls short-term interest rates, what the banks charge each other to borrow money overnight. The mortgage rates are tied to the 10-year Treasury yield, which is driven by long-term inflation expectations, investor sentiment, and global economic conditions. In fact, after the Fed cut rates 3 times the end of 2025, mortgage rates actually went up a bit. The Fed cut rates and mortgages got more expensive. Daryl Fairweather, the chief economist for Redfin, put it this way: the Fed controls short-term interest rates, but mortgage rates are more about how the market expects rates to change over the long term. The bottom line is, waiting for the Fed to rescue mortgage rates is waiting for something that may never come, at least not to the degree that a lot of buyers are hoping. Economists and housing analysts are increasingly using the phrase new normal to describe a rate environment in the 5.5% to 6.5% range. The 2 or 3% rates from 2021, 2022 were an extraordinary anomaly, and those days are gone. Even the most optimistic projections of rates going down into the 4s would require either significant economic weakness or a recession, and neither of those is really good for the economy or job security. Now I want to spend a couple of minutes talking about what almost nobody talks about when they talk about waiting for interest rates to drop, and that's this: everybody is waiting. It's not just you. A March 2025 survey by US News found that 4 out of 5 homebuyers are waiting for interest rates to drop before they buy. Just think about that for a second. Over 80% of homebuyers are waiting on the sidelines for the exact same thing that you're waiting for. The moment rates drop anything meaningful into the 5 to 6% range, every single one of those buyers comes flooding back into the market at the same time. But here's the economic reality, and that's the housing supply in Salt Lake County, already tight at 2.9 months, does not suddenly double when the interest rates drop. Inventory doesn't expand overnight. It takes time. But demand can explode in a matter of weeks. And when that happens, we'll go back to multiple offers on every single home, waived inspections, bidding wars that push prices up 5, 10, 15% over their asking price. Sellers who have been offering concessions for years now suddenly don't need to. And first-time homebuyers who were positioned perfectly now go back to fighting over every single home they go into. The Salt Lake Board of Realtors projects that the median home prices will reach between $560,000 and $572,000 in 2027, which is just about 2% in annual growth. And that's not accounting for if we do have a demand surge, if we do have a sudden drop in interest rates. So let's take a look at a real-world example just to illustrate this. Let's say you're looking at a $550,000 home in West Jordan, Utah today. In scenario A, you buy now at a 6.5% interest rate with 5% down. That's about $27,000 down on a $522,000 loan. Your monthly principal and interest are going to run you about $3,300. Over 3 years, you build equity as the house appreciates, even modestly. In scenario B, you wait 18 months. Rates drop to around 5.75%, but competition pushes prices up 5%. Now your purchase price is $577,000, and your loan is going to be $548,000. Your monthly payment and interest on 5.75% is now still about $3,200. Yes, you're saving about $100 a month, which is great, but you paid $27,000 more for the home. It would take you over 22 years to recoup the price difference with the lower payment. Meanwhile, you paid rent for an additional 18 months, which is likely anywhere from $18,000 to $2,500 a month, which is going to end up being $27,000 to $45,000 out of your pocket with no equity built. Waiting for a slightly lower rate while prices continue to increase and you just keep on paying rent is never going to be a winning move. You're trading a sure thing, which is buying now, for an uncertain savings that may never materialize. If you're like me, you've heard the phrase date the rate, marry the house ad nauseum over and over again, but it really is true, and it definitely pertains to the situation that we're in right now. You're not married to your interest rate. You're not stuck with it. You can always refinance when rates go down, but you are married to the price you paid and the house that you bought. If you buy today at 6.5% and rates fall to 5% in a year or two, you just refinance. Your payment will go down. You get the house at today's prices, you get today's seller concessions, and you lock in the home before the new wave of buyers arrive. Okay, so let's say you're convinced or at least open to buying a home right now. The next question is, how do I make sure that the numbers work? How do I get the lowest possible rate and the best possible deal in this market? The good news is that there are more tools available to buyers right now than there have been for years. So let's take a minute and just walk through each one. In the competitive market of 2021, asking for seller concessions was basically a joke. It was an absolute waste of time. You'd lose the home immediately, if not just get laughed out of the room. But 2026 is a very different story. With homes sitting on the market for 62 plus days in Salt Lake County right now, sellers are becoming more motivated. They need to sell their home. And one of the most powerful things you can do right now is ask for seller concessions to pay for a rate buy down. Here's how that works. You ask the seller to contribute, say, $10,000 or $15,000 towards your closing costs. And instead of keeping that money in your pocket, you use that money to buy discount points, essentially prepaying interest to permanently lower your mortgage rate. Each point typically costs about 1% of your loan amount, and it will reduce your rate by about 0.25%. On a $550,000 loan, 1 point will cost you about $5,500, and it would drop your rate from 6.5 to 6.25. And that savings is going to equate to about $85 a month, which is about $1,000 a year, which is about $30,000 over the life of the loan. With $15,000 used for buy downs, you could potentially lower your rate by 3/4 of a point, turning a 6.5% rate into about a 5.75% interest rate. And that's every single month for 30 years. It's a great way to save money, taking advantage of the market that we're in right now. Beyond permanent rate reductions, there's also incredibly effective strategies called temporary rate buy downs, specifically the 2-1 buy down. Here's how that works. The seller pays a lump sum of money that is held in an escrow account. This money subsidizes your interest rate for the first 2 years that you own the home. Year 1, your interest rate is reduced by 2 percentage points, so your 6.5% rate goes to 4.5%. Year 2, your interest rate is reduced by 1 point, so your 6.5% rate goes to 5.5%. And then year 3, your interest rate goes to what it was to begin with, 6.5%. The beauty of this strategy is that it gives you a significantly lower rate and payment for the first 2 years that you own the home. And this is the time that you're settling into your home and you're spending the most money. You're buying furniture, you're moving, you might be doing updates and making adjustments, but at the same time, you're making a reasonable bet that interest rates are going to drop over the next 2 years and you'll be able to refinance. Edge Homes, a major home builder here in Utah, is offering exactly this type of structure on select homes that they're selling, with year 1 payments starting as low as 1.99%. And that's not just a teaser rate, that's a real rate that's paid down by the builder. Which brings me to my next point. If you haven't looked at new construction, it may be time to check it out. Utah builders are in a very interesting position right now. They have construction loans to pay off, investors to answer to, and inventory that needs to move. A lot of them have several spec homes that they've been sitting on and paying interest for. That means they're willing to offer incentives that they haven't been able to offer for years, and those incentives can be massive. Here's just a small sample of what some of the builders are offering as of 2026. Perry Homes is offering a $21,000 lender incentive that you can use to buy down the interest rate, pay off closing costs, or reduce the purchase price of the home. I just mentioned Edge Homes. They're offering the 1.99% on select homes, or up to 9% incentives that you can use for all those same things, buying down the rate, taking it off the price, or using for your closing costs. D.R. Horton is advertising interest rates as low as 3.875, and Richmond Homes has also been offering great incentives, as well as lower rate options and free finished basements. These are real dollars that builders are putting on the table to close deals, and these incentives applied to rate buy downs and such can save you hundreds of dollars a month and tens of thousands of dollars over the life of the loan. And there's another advantage to new construction. There's no bidding wars. You know what you're paying. There's no mystery repairs or negotiations when it comes to fixing a leaky roof, no old plumbing surprises, no wondering what's behind the walls. Everything is new, and they almost all come with a builder warranty. I've represented buyers when they are purchasing new homes with dozens of different builders in Utah. I know how the process works. I also sold homes for a builder for over 6 years here in Salt Lake County. I know the process inside and out, so if new construction is something you'd like to consider, I could certainly help. Now, the next topic surprises a lot of buyers. Utah has real meaningful programs to help buyers get into a home. There's still a Utah first-time homebuyer program that offers up to $20,000 in assistance to buyers looking to purchase their first home when it's new construction. And there's no monthly payment required on that money. It's just repaid when you sell or refinance the property later. In Utah County, there's a down payment assistance program that offers up to $40,000 for qualified buyers in Utah County. There's Utah Housing Loans that offers $0 down, FHA loans with down payments as low as 3.5%. And then there's VA loans for our veterans with $0 down as well. These are programs that aren't necessarily advertised on billboards. A lot of buyers don't even know that they exist. And that's why working with a knowledgeable, experienced realtor is something that's going to help you save thousands of dollars in the long run. One of the most overlooked ways to save a lot of money is by simply shopping your mortgage rate. Too many buyers will go with the first lender that they talk to, but even a 0.25% difference in your mortgage rate will make a big difference in the long run. As I mentioned before, on a $500,000 house, a 1/4 point difference is about $85 per month, or $30,000 over the life of the loan. A 1/2 point is about $170 a month, or $62,000 over 30 years. And that is a lot of money to just pass by and go with the first offer that you receive. Additionally, it's important to remember that your credit score has a big impact on the rate that you'll receive. Lenders will tier their rates by the score that you have. So it's important that you are well aware of what your credit score is, that you try to pay down any revolving balances, and make sure that there's no errors in your report, because a small difference in your credit score could mean the difference between 1/4 and 1/2 percentage, which could be the difference in thousands of dollars. Now I want to zoom out for a minute and talk about why Utah, specifically Salt Lake County, is not the kind of market where you wait for a crash. Utah continues to be one of the fastest growing states in the country. We have a disproportionately young population. 35% of all mortgage loans taken out last year were taken out by a household that was headed by someone between the ages of 25 and 34 years old. That's an enormous built-in demand. Young households form, they buy homes, they build families, they need space. And Utah's 25 to 34-year-old demographic is one of the largest cohorts in the state, meaning demand isn't going away, it's growing stronger over time. Salt Lake City continues to attract tech companies, financial service firms, and healthcare employers. The metro area's diversified economy has historically protected it from the dramatic bust seen in other markets. Utah's job growth is expected to rise by about 1.5% in 2026, which is modest but positive. And strong employment means that residents can qualify for mortgages. It means they have income to support home ownership. It means there's ongoing demand for housing. The Wasatch Front has geographic constraints that many markets don't face. Mountains to the west and east, the Great Salt Lake to the north, and a finite valley floor means you can't just build infinitely. New construction is definitely happening, but not fast enough to outpace demand at current population growth rates. Analysts note that demand for new housing is simply outpacing supply, which is a strong structural support for home prices over the long term. So let's bring this home. Pun absolutely intended. The question isn't whether interest rates will come down. They probably will, a little bit. The question is whether that modest drop will outpace rising home prices, more competition, less equity, and months or years of rent payments while you wait. Based on everything that we've discussed today, the answer is almost certainly no, it will not. But here's what you can control right now in this market. You can expect to negotiate with motivated sellers and ask for meaningful concessions. Use those concessions to buy down your interest rate permanently or get a temporary 2-1 buy down. Explore new construction where builders are offering tens of thousands of dollars in incentives and lower interest rates. Take advantage of state assistance programs, offering lower interest rates or tens of thousands of dollars in potential subsidies. Shop multiple lenders and work on your credit score to get the best possible rate. Lock in today's prices before the next wave of buyers and competition surges. The bottom line is that every experienced economist and real estate professional keeps saying the same thing. The best time to buy a home is when you're financially ready. You've found the right property and you can afford the payment. And all three of those things may be true for you right now. Waiting for the perfect rate is waiting for a moment that may never come. And while you wait, the prices go up. Your rent continues to go out the window, and the window of negotiating power closes. If you have questions about the Utah real estate market, want to talk through your specific situation, or if you just want to know what you can currently afford right now, drop a comment below, reach out directly, and hit the subscribe button so that you don't miss the next deep dive video. I'll be sure to put all of my contact information in the description below. Thanks so much for watching, and I'll see you in the next one.